Mind Your Farm Business on realagriculture.com is brought to you by RBC Royal Bank. Hello and welcome to Mind Your Farm Business, brought to you by RBC Royal Bank. I am Lindsay Smith and I will be your host for this episode, and it's a pretty neat one. We're going to talk about that all-important decision of buying versus leasing equipment. How do you make the decision? What you need to think about? And we're going to challenge that oft thought about tax implication. Do you think leasing gives you an advantage? You might be surprised to learn that with new legislation that came out in 2018, the balance has shifted. And if tax implications are the first thing you're thinking about, buying may actually have more of a benefit. At the same time, Lance Stockbrugger wants to challenge that idea, that realistically, the tax implications fall somewhere down the list past first place when it comes to making these very important decisions for your farm. All that and more coming up next on Mind Your Farm Business. Well, welcome here to Mind Your Farm Business. I'm joined now by Lance Stockbrugger. He's a farmer, grain farmer, producer from near Watson, Saskatchewan, and was also a chartered accountant for 20 years. But of course, you saw the light, right, Lance?
You betcha.
Yes. And so now today on this episode, we're going to talk that buy versus lease decision. It's a discussion that will never go away, I don't think. But when we're talking about, fitting a new piece of equipment onto the farm, you've got to make that critical call. Do you buy versus lease? And most farmers, I think, still think it's a tax decision. But you're going to tell us it's not. So walk us through it.
That's exactly correct, Lindsay. I think the biggest thing that I started this presentation, or why I tried to educate people with this, is that when I was in active practice, people would call me almost weekly saying that they decided that they needed a new piece of equipment and they were at the dealership or they were going to the dealership and they thought that maybe they should lease it. And I would ask why would they be considering a lease? And 9 times or 95 times out of 100, they'd say, well, because it's better for me for taxes. And I said, well, that's not usually the case. Leasing has its place, and it can be used at a, as an effective tool, I guess. But to try to save taxes is not going to be one of them. And so that's why I started doing this presentation. And I think a lot of people understand now that I've talked to that, leasing for cash flow reasons, different reasons like that, as to why they would consider a lease versus a buy. But if they're simply trying to get tax write-offs, in most cases, buying is a better option for them.
All right, so walk us through that. So why? Because I do think it is sort of a widely held belief or misconception. So where do you think that stems from?
Well, I think that it stems from the fact that they think that they can, if they write off 100% of their lease payments. And that's true. That's completely right. But where it got sidetracked was in the definition of what a lease is. And basically for tax purposes, in order for there to be a lease for tax, it cannot have a bargain purchase at the end. So if the purchase price is anything less than what the estimated fair market value is at the end of the lease, then you probably don't have a tax lease. Now, saying that, Revenue Canada, up until recently, has taken a very back seat in terms of analyzing these type of transactions. They've been saying, well, if it says it's a lease, we'll treat it as a lease, and they don't really get into arguing about the fair market value. But this is an area that they feel has been taken advantage of by producers and by taxpayers, and so it's something that they're taking a more proactive look at it. So the fact that you might have had leases in the past that had a bargain purchase at a buyout of $1 or the last payment, and if you had that and you filed your tax returns, nobody's ever questioned it, chances are that's okay. But to say that just because I've done it in the past means I'm going to be able to continue to do it in the future isn't always the case. So I'd be very cautious about getting into new leases that have a bargain purchase at the end, because if there's a bargain purchase less than the fair market value at the end of the lease, chances are Revenue Canada is not going to treat that as a lease going forward, and they'll come in and reassess you and show it as a purchase price.
All right. So let's, if we're going to take the tax implication potentially out of the mix from that sort of cut and dried angle, how then do you lay out the pros and cons of buying versus leasing?
Well, I think the biggest thing that people need to think about is leasing can have a very good fit for areas where you have multiple units, where you're maybe buying more than one piece of equipment. Maybe you're expanding and you don't have a trade-in, so you need to acquire, say it's another combine or a sprayer, whatever the case may be, where it can be actually a lower out-of-pocket cash cost in order to get that asset, because with a purchase, you have to pretty much come up with 25% down in order to buy that piece of equipment. And if you don't have the trade-in or that 25% down, leasing might be a better option for you, because you can get into the lease for the first payment. And quite often that first payment is a lower cost, lower cash cost than trying to come up with 25% down to buy the whole asset. The other thing that people might want to look at is if they're regularly flipping pieces of equipment. So if there's, let's say for instance, they're in a program where they think, I want a new combine every 2 years or every 3 years. So a lease might have a very good fit for them, because they don't want to buy the whole combine. That combine might have 5,000 useful hours in it. They only want the first 600 hours. So why not just pay for those first 600? So then that's what a lease does, is they're basically just paying for the hours that they want to use that piece of equipment, and then in 3 years they give it back and they get another new one. So if that's what they're wanting to do, then that's where a lease can work excellent for you. It'll be for people that don't really want to build equity in equipment. If they decide, a combine's not a good place to build equity, I'd rather build equity, in my farmland or buildings or even other pieces of equipment that maybe are more apt to build equity in, then buy those pieces of equipment. But in the pieces that they feel that there's no equity to be gained in, they don't want to build equity in those pieces of equipment, then they should be just paying for the part they want to use, and by doing that, they would enter into a lease.
We've got to take just a quick break here on Mind Your Farm Business, brought to you by RBC Royal Bank. But stay tuned for more from Lance Stockberger just after this.
This episode of the Mind Your Farm Business podcast is brought to you by RBC. Today's producers are thinking hard about where they want to go and what moves to make to get them there. A business plan is your roadmap to success. Without one, it's easy to get lost along the way. You can count on the services and expertise RBC offers to help you meet your business goals and chart a course to success. Visit rbc.com/chartyourcourse to find an agriculture account manager near you.
All right, so I'm going to throw you a curveball, because we're dealing with people, and people are interesting things. And if you're the kind of producer that takes super good care of your equipment, you lovingly wash it, it's always going to be under roof, you're meticulous in keeping them tidy and clean, are you better off buying or leasing? How does the type of producer you are and how you treat your equipment factor in?
Well, yeah, I think, if that's the case, chances are if you're looking after that piece of equipment meticulously, you're doing that because you want to keep it for a longer period of time, I would assume. However, leasing that might not be a bad situation, and being like that might not be bad for you either, because the dealership's going to be taking that piece of equipment back. And so they know the condition, or they can assume of the condition that it's going to come back in, and they might be able to provide a better lease option for you than somebody that they know is never going to grease it, never going to wash it, never going to even put it in a shed. And therefore, they're going to get more of a return on that piece of equipment when they try to sell it again when it comes back to their lot. So I'm not saying don't look after it if it's leased, because there's also reclamation costs that a lot of people aren't aware of, and that's very important to think about when you're entering into a lease, is to ask what's this going to cost me in the end, because at the end of the day you need to replace or return it in a usable format. So if it's wrecked or destroyed, you might very well have to pay to get it fixed, to get it back to a usable format. So leasing works great, but make sure that you read all the fine print and look into all of the descriptions of what you're responsible for during that lease term.
Right, and that does actually bring us to my next question, which is exactly that, of what are some of the things in a lease that trip up farmers?
Well, that's one of them, and some can be very loose in terms of what the reclamation is going to be, and others can be very specific, so that might have to go through their dealership's back shop and have to get basically brought back up to snuff. Other things that people need to be aware of is that leasing is a financing contract, and a financing contract has interest rates associated with it. So ask what the interest rates are on a lease, because sometimes the interest rate on a lease might be significantly higher than what a buy could be. So you're going to end up paying more in interest costs than what you would normally if you could just afford to buy it. Another thing that people don't always understand is that there is, because cash farmers are cash basis, they are allowed to, anything that they write or that they pay for, they can write off. So some people might, in a significant tax situation, they might say, well, I want to prepay my lease for the term of 5 years. If I prepay it, I can write off all those 5 years worth of lease payments. Well, that's not the case in leasing. You're only allowed to write off 2 years of a prepaid lease. So even though you might prepay the whole lease and have no other cash costs after that first year, you're only going to be able to write off the first 2 years, and then the other 3 years are going to be amortized over the life of that lease. So there's no benefit to prepaying the lease if you're going to do that.
Right. So it is capped at those 2 years, so you can't necessarily do that. Okay. So then, I mean, we've talked a lot about leases, but there's still, of course, considerations for buying. So what are some of those things that tip it in the favor of purchasing that equipment?
Well, I think, like you mentioned earlier about looking after your equipment and building equity. Some people might have the stance that if they can build some equity, if they look after it, it'll last them a long time. It won't depreciate much after the first few years. If that's the type of mentality that they have and the way that they want to run their farm, then buying has a better option for them. The recent changes, actually, just in the tax rules that just happened here in the fall of increased capital cost allowance in the first year, are going to result in far better tax treatment buying it than leasing it, because you can write off, on a motorized piece of equipment, you're looking at writing off 45% of the purchase price in the first year. So if you're looking for tax write-offs, then probably buying it now under the new tax rules are going to be beneficial for you to do that. The other thing to consider is that lease payments do attract GST or HST depending on the province you're in. So you're going to have an extra cash outflow paying that cost. However, it is refundable to you through an input tax credit, but it is going to be an extra out-of-pocket cash that you're going to have to pay based on a lease. Whereas buying it, there's no GST or HST implications provided it's exempt piece of property.
All right, so plenty of things to consider. And we didn't even back up to, should you really be buying this piece of equipment, which I suppose we could talk about.
For sure.
But that's probably a whole other podcast. But maybe let's briefly, certainly in this, environment of increasing interest rates and those sorts of things, what are some of the basics of, before we even get to the buy versus lease, what should farmers be sort of, at least at a basic level, looking through?
Well, I think the equipment that they have. I'm a big proponent of a 5-year capital budget. I know on our farm we do that, to where we figure out when do we want to replace a piece of equipment and when's it going to make the most sense to do that. And so I would strongly encourage people to start doing that, and then trying to follow it as best as they can. So it might be that there might be good options, good available lease rates at certain times of the year, and they might look at, this is a piece of equipment that they're going to be updating, so they might want to look at leasing that versus buying it. It comes down to, I think, really cash flow is the biggest thing. Do they have the money to pay for that piece of equipment? Certainly to come up with a down payment for the loan, or do they? Is a leasing it and paying the GST or HST on top of that a lower cash cost for them to get into that piece of equipment? Then that's, to me, ignoring the tax implications, it really should be making the decision on, do I need this piece of equipment? Is it going to benefit me? Is it going to add more profitability and more, make me better at the job that I'm doing? And is that going to add to the bottom line for them? And if it does, then look at the different financing options and treat leasing versus buying just as an off financing option. It's another way to acquire a piece of equipment is really the important way to look at it.
All right, Lance, thank you so much for your time today. This has been super insightful, and maybe a bit of a truth bomb for some people, that there may actually be a tax benefit to buying instead of leasing. So thanks so much.
Thank you, Lindsay.
And that's all the time we've got for this edition. of Mind Your Farm Business. Thank you so much for joining me, Lindsay Smith, your occasional host on this podcast. For more, you can go to realagriculture.com and see all the episodes. And thank you for minding your farm business.